Let's imagine you're the CEO. It doesn't matter if you run a lemonade stand or Google. Every single day, you have to answer the same 3 questions. And if you get them wrong, the company will begin suffering. These questions are: what projects should we spend our money on? Where do we get the money to pay for them? And how do we manage our cash? Let's begin by giving a more formal definition of corporate finance. Corporate finance is the area of finance dealing with the financial decisions a company makes to maximize its value. Many people confuse finance with accounting, so let's clarify this early. Accounting is the language of business. It is about organization and precision. It focuses on recording what happened in the past. Therefore, you can think of accounting as telling you what happened last quarter, last year, etc. Corporate finance, on the other hand, is the logic of the business. It is forward-looking. It's about decision-making in an uncertain world. Corporate finance asks, what should we do in the next quarter, next year, etc. In this video, we're going to cover the primary goal of the firm. The 3 pillars of corporate finance, those being capital budgeting, capital structure, and working capital. And finally, the conflicts that arise between managers and owners. Before we make any decisions, we need a target. What is the ultimate goal of a corporation? If I asked you this in a casual setting, you would probably say to make a profit. And while making a profit is obviously good, in finance, maximizing profit can actually be a dangerous goal. You might ask why. Well, because profit is vague and can be easily manipulated. For example, you could maximize this year's profits by firing all your R&D staff working on the next great lemonade recipe. We could cancel our safety food inspections and sell off our best equipment. Your accounting profit for this year would look incredible because your expenses went way down. But you would have destroyed your company's ability to compete and generate more money next year. You basically sacrificed the future for the present. Therefore, in corporate finance, the standard goal is shareholder wealth maximization. This means maximizing the current value of the company's stock. The stock price is typically a much better metric than profit because it is efficient. The stock price reflects everything. It reflects your current profits, yes, but it also reflects your expected future growth, and more importantly, it reflects the risk the company is taking. If a risky decision that endangers your company is made, the stock price will drop, even if your current profits look fine. So, if you make a decision that increases the stock price, you are theoretically creating lasting value for society by using resources more efficiently. Now, in a quick caveat, in modern finance, it is also becoming more important to talk about stakeholder capitalism, or ESG, environmental, social, and governance. This argues that you cannot just focus on the shareholders. You must also care for employees, customers, and the environment. However, this isn't necessarily a conflict. To maximize shareholder value in the long run, you must treat employees well, or they will quit. You must serve customers ethically, or they will leave. If you pollute the environment, you might save money today, but your stock will crash when the government fines you or shuts you down. So, even with ESG, the core goal remains: maximize long-term value. Now, let's look at 3 major decisions you will make to achieve this, starting with the most important one, the investment decision, also known as capital budgeting. This answers the question, what long-term assets should we buy? Should we spend $1 billion developing a new type of lemonade drink? Should we open 500 new stores? Or should we keep that money in a bank somewhere and invest it? To answer this, financial managers use tools like net present value, NPV, or internal rate of return, IRR. We will cover the math of these in future videos, but the logic is simple. A project is worth doing only if the cash it generates in the future is worth more than the cost of starting it today. The key concepts here are valuation and the time value of money. In capital budgeting, the size, timing, and risk of future cash flows are everything. A dollar today is worth more than a dollar tomorrow. If a new blender costs about $100 today, but only returns $100 in 10 years from now, well, then we can kind of assume that's a terrible investment due to inflation and lost opportunity of those dollars. You could have just put the money in a savings account and earn interest and have more money in 10 years' time. So corporate finance helps us calculate exactly how much that future cash is worth today so we can compare apples to apples. Let's say we want to procure the new blender. Well, we need to pay for it. This leads us to our second pillar, the financing decision or capital structure. This answers the question, well, where do we get our cash from? Basically, you have two options, debt or equity. You can borrow money by taking a loan from a bank or selling bonds to investors, or you can sell ownership by selling shares of stock. This is a big trade-off. Finding the right balance is an art form. If you choose debt, it's generally cheaper, but the interest you pay on debt is mostly tax deductible, which saves the company money. However, debt introduces a specific type of risk, bankruptcy risk. The bank doesn't care if you had a bad month, bad quarter, whatever. They legally demand their interest payment. And if you can't pay, you go under and the bank seizes the assets. Think of it like building a bigger lemonade stand. If you take out a massive mortgage, you can build the bigger stand. That's leverage. But if people stop buying our lemonade and we don't have enough profits to cover the actual mortgage, then the bank will take the lemonade stand. On the other hand, if you choose equity, it's safer. If you have a bad year, you don't have to pay dividends to your shareholders. You just tell them, sorry, maybe next year. However, equity is expensive. Selling shares means you are selling a piece of the company. You are diluting your ownership and giving up control. Plus, some shareholders expect a high return because they are taking a risk on you. Corporate finance is all about finding the optimal capital structure. Think of this like the Goldilocks mix of debt to equity that minimizes the cost of money while keeping the company safe from bankruptcy. The third pillar moves us from long-term to short-term, working capital management. Capital budgeting and structure are about the next 5 to 10 years. Working capital is about the next 30 days. This answers the question, how do we manage day-to-day financial health? This involves managing the gap between when you spend cash and when you get cash. It involves inventory. Do we have enough product on the shelf to sell, but not so much that it spoils or ties up all our cash? It involves receivables. We sold the product, but have our customers actually paid us yet? And payables. When do we have to pay our suppliers? This is critical because of a concept called liquidity. You could be a profitable company on paper, but still go bankrupt. Well, you might ask how. Imagine you sell 1 million iPhones today. Your accounting profit looks amazing. But if those customers don't pay you for 60 days and your electric bill is due tomorrow, you have a problem. You are illiquid. You ran out of cash to pay the bills despite being profitable. Corporate finance teaches you how to manage this cash conversion cycle so you can survive. Finally, we have to address the human element, the agency problem. In small business, the owner and the manager are usually the same person. If you run your own lemonade stand, you make decisions that benefit you. But in large corporations, the person who owns the company, the shareholders, are not the same people who run the company, the managers or the CEO. This separation creates a conflict of interest. Shareholders want a higher stock price and managed risk. But what might a manager want? They might want job security, so they avoid risky or profitable projects. Or they might engage in empire building, buying up other companies just to make their corporation look bigger and more prestigious, even if it wastes money. They might want a corporate jet or a fancy office, and these are called agency costs. Corporate finance studies how to align these interests so that the managers act like owners. This is often why CEOs get paid with stock options. If the stock goes up, the owner wins, and the manager gets rich. We try to tie the manager's personal wealth to the company's performance to solve these agency problems. So, to wrap up, corporate finance is the study of decision making. Capital budgeting, deciding what assets to buy to create value. Capital structure, deciding how to pay for those assets using either debt or equity. And working capital, managing the day-to-day cash to ensure the firm survives. All of this is done with one specific target: maximizing shareholder wealth. Thank you for watching this video, and I hope it helped your understanding of what is corporate finance. If you enjoyed, please like, subscribe, and consider checking out our YouTube memberships by clicking that join button down below. However, if you have any comments, questions, or concerns about the information I provided in this video, please leave a comment down below, and I will do my best to address your concerns.